For the first time in a long time, the market isn't just betting that the Fed won't cut, okay? It's actually betting that there's a real chance that the Fed actually raises the rate next week. And the reason? Oil. Three things today. First, what actually made the market possibly flip from a no cut to a possible rate hike? Second, has an oil spike ever forced the Fed to hike rates? And third, what does this mean for you in your next move? So let's get started. The Fed cutting rates was basically the whole plan for the second half of this year. The administration was excited to be getting rid of the data-driven, boring Fed chairman, Jerome Powell, and it was pumped to be replacing him with a person who was more hawkish on the economy, right? And that would be the new Fed chair, Kevin Walsh. And it was supposed to be this meeting at this time where Walsh, I can't even say his name right, where Walsh was going to let people know that, the Fed is under new management. A new sheriff is in town, and that town is going to be ran the way he wants, right? He's going to make things cheaper and more affordable for the American people. Then Iran happened. Well, it didn't just actually happen. We've been fighting with them since June of 2025. But our problem, or should I say Chairman Walsh's problem, is that Iran won't go away. And what could I possibly mean by this? All right, let's talk about it. Iran's supreme leader, gone. Iran's top military generals, gone. Iran's top intelligence ministers, gone. Not to mention food shortage, check. Destruction of currency, well, with an 88% inflation rate, I'd say check. Civil unrest, 70% of people report show or higher, actually up to 90% of Iranians want to see the regime gone. So check. And yet the Islamic Republic of Iran isn't batting an eye, right? That's unless you're talking about oil. They're not, if you're talking about oil, then they're not just batting an eye. They're eye batting with a smile. Okay. And this is because Iran's resistance, it's pushed crude oil to over $100 a barrel. And that, my friends, is a good way to put the fear of inflation front and center at next week's Fed meeting. All of a sudden, we went from a hawkish, pro-growth Chairman Walsh, meaning let's cut the rates, to in the span of just weeks, not only are they not talking about rate cuts, some in the market are quietly betting on a rate hike. According to this chart, there's now a 35% chance of a rate hike next week. And here's how that talk is already affecting your mortgage rates. Let's take a look at the 10-year Treasury, right? That's the thing that actually tracks your mortgage. Not the Fed directly, it's the 10-year Treasury. And that closed around 4.71% today. 4 straight sessions of climbing. It's highest it's been since January of last year. And the thing dragging it up isn't the job numbers. It isn't the inflation report that came out earlier this week. It's oil. Brent crude's sitting roughly right around $100 a barrel right now. The American domestic oil is roughly in the low 90s. Patience of things actually getting worse, not better. And people would say, why? Pretty easy to tell. It's because now we got more war fronts. I mean, you got the Houthis attacking Saudi tankers in the Red Sea. You got Kazakhstan, if I said that right. You got Kazakhstan shutting down a pipeline after drone strikes. And with all this happening, you got some analysis people, some of the brainiacs, predicting that oil could be at $120 a barrel come this fall. That's where the possibility of a possible rate hike is coming from. Now, listen, there's still a 65% chance that the Fed will hold and stay where it's at, right? I want to be fair about that. But a month ago, rate hike, that wasn't even in the conversations. And now that it is in the conversation. And Freddie Mac's got the 30-year fixed rate at 6.58%, near a one-year high. On a $400,000 loan, a quarter point runs you roughly about $65 a month. Call it $780 a year, every year that it holds, right? That's what basically made the market change its bet, going from staying where it's at to 1/3 of a chance that it might actually hike rates next week. So the market's scared that oil is going to force the Fed to raise rates. That's fair. It's a real fear out there. But I went and checked, okay? I went and checked, has an oil spike ever actually forced the Fed's hand? The answer, very surprising. Not what I was expecting. And here's the simple version. Expensive oil makes gas cost more, right? Which makes shipping cost more, which drives up the price of literally everything you buy. But the Fed isn't worried about expensive oil, okay? They're terrified that people will accept high prices as the new normal, and And when people do that and start acting like it, that's where the problem begins. Meaning saving money because you're afraid of spending money. That type of action, that's what trickles down to the rest of the economy. Going to the movies, too expensive. Going out to eat, too expensive. Going to the bar with your friends, too expensive. And you might be right. And that's because everything you touch had to be trucked in by expensive oil. Oil price hikes are just the match, essentially, that lights the fuse in any economy. But it's everybody expecting for the worst is what actually causes this explosion. So now let's take a look back at history. Did you actually know that we've actually had this set up, war, oil shock, Fed on the spot? This has happened 3 times in the past, and it didn't go at all the way that we thought it would on each occasion. Back in 1973, 74, war in the Middle East triggered an oil embargo, okay? And what happened there was that made oil prices jump up 4 times higher, basically overnight. Inflation shot up from 8% up to 12%. But instead of the Fed stopping or doing something about it, it did the exact opposite. It did almost nothing. And because the Fed actually stayed out of it, didn't take any actions to curtail this, inflation completely spiraled out of control. That was definitely a lesson learned, and we can assume that the Fed will not stay out of things this time around. And the second time this happened was back in 1979, the Iranian Revolution. Supply barely dropped when this happened, okay? Just a few percent. But crude oil doubled, and inflation soared up to 14.5%. And that's essentially what everyone's scared of today, of happening or replaying itself. And the reason that people are worried or feared about this scenario is because what the Fed did in order to combat this problem. Volcker, who was the Fed chair at the time, he raised the Fed funds rate to up to 20%. That was how he combated the problems that were ahead. But here's the part that's often skipped, okay? That scenario wasn't about oil alone, all right? That was a full-blown wage price spiral, okay? It was fueled by inflation, and because of that, expectations of what was going on and how everything was getting treated, it eventually spread nationwide and affected everybody nationwide. All right, moving on. Let's go ahead and fast forward to 1990. That's where Iraq invades Kuwait, and oil prices at the time that happened shot from $15 a barrel up to $42 a barrel in just 2 months. That's a massive 75% jump. This is so much bigger than the spike that we're seeing today. Based on what happened in the 70s, you'd expect total panic, right? But this time, inflation barely budged. Inflation peaked at 6.4% and then literally quickly leveled out. And on this scenario, the third time it happened, instead of the Fed raising interest rates, they did the exact opposite. So why did the Fed jack up the interest rates up to 20% in one scenario, but then cut them right in the middle of another scenario? Because it wasn't about how big the oil spike was. It was about whether people expected inflation to stick around. In 1979, inflation fears were spiraling out of control. But by 1990, the Fed had earned its credibility back, thereby allowing the same kind of oil shock to just run its course. That's the pattern, okay? An oil spike on its own almost never forced any Fed chairman or Fed body to jack up interest rates. What actually decides their move, or what they decide to do, is whether everyday people trust the Fed to keep prices under control. So the real questions for next week's meeting isn't how high oil will go. It's, do people still believe inflation will stay temporary? Personally, I think it is. Whether we clear this hurdle next month, right, or maybe it plays out into the next administration. Either way, my view is once this conflict with Iran cools down, oil will be plentiful again. America is already pumping at record levels, and bringing sources like Venezuela back into the mix adds even more capacity. And at the end of the day, once this war clears, my money is on optimism. So what does this mean to you guys? Well, let's go ahead and put the pieces together. That scary 1979 story where rates hit 20%, it was real, right? But it only happened because economic panic had already taken over. Today's situation is nowhere near that. Wall Street only sees a 1 in 3 chance of another rate hike. And honestly, that's far from a done deal. Well, here's my takeaway. Unsolicited advice. Don't base your biggest financial decisions on a coin flip, okay? A rate hold is still the most likely outcome. And history shows that an oil spike alone, it doesn't force the Fed's hand. Runaway economic panic is what does. And that's what we need to watch, not just the oil headline. Could rates nudge higher? Sure. Is this a real risk that we need to respect? Of course. But it's not a reason to freeze up. And why? Because we could just look at what already happened. Mortgage rates and bond yields have already risen 4 days in a row. A lot of that, what if the Fed hikes fear, is already priced into the rates that you're seeing today. We aren't waiting for bad news to hit. To a degree, we're actually already living in it. So here's where that should leave you. For the people who are still shopping for a home, while everybody else is scared off, right, and leaving the market, the people that are still shopping, those are the ones that are getting the real leverage right now. More room to negotiate, fewer competing offers, sellers actually paying attention to you. You buy your home now on the terms that you can win. And then you keep the option to refinance later if this whole oil thing burns out like it did in 1999. That's the best of both worlds, right? You do not have to predict the Fed in order to make a smart move this week or next month. So here's what I want you walking out with on the Friday where the market was starting to bet against the one rate cut everybody was counting on. And it's an old saying in finance. Real wealth is made when you stop following the crowd, okay? Back in 2008, when people were running for the exits, the smartest buyers weren't panicking. They were quietly securing long-term value while everyone else froze. We're seeing a version of that right now. While fear of interest rates are driving a lot of buyers onto the sidelines, the real deals are being made by people who are still in the game. Right now, sellers heavily outweigh buyers, which hands the buyers an overwhelming advantage. Okay? You have all the negotiating power as the buyer that you could ever ask for right now. Demand price cuts, demand seller credits, and terms that you feel that you probably couldn't get in a hot market. Smart decisions rarely feel comfortable in the moment, okay? But history shows that stepping up while others are backing out is how you win in the long run. And hopefully all this information was worth your time. And please remember, life's not meant to be, it's meant to create. Too strong.